Stephen Major of Tradition to Buy writing, central banks can initiate rate hiking cycles to tame inflation, but underlying debt dynamics ultimately dictate how those cycles end. Stephen joins us now for more. Steve, my friend, it's good to hear from you. It's good to see you.
Hi, John.
Are we on the brink
Likewise.
of some bond market pushback, limiting the ability to hike rates here at some of these central banks?
Well, the focus is Jackson Hole already. I know it's a week or so away, but people are now discussing what's going to come up at these meetings, because it's very often the case that big set-piece moves happen at these conferences. I think that you've reported the impact of debt and fiscal dynamics on bond yields and earnings. And I think that you're quite right. It's a bit more complicated than just the debt levels or the fiscal position, because when earnings are so strong, then the risk premium that goes onto the bond yields or the term premium has to be higher. I mean, try explaining to a young person why they should buy bonds when equities keep blowing the lights out every week. So it's quite simple. There's the risk premium, and I think the fiscal dynamics are somewhat worrying. I guess you could say there's an international effect as well on the long end of bond curves here in the JGBs at the moment, but a few weeks ago it might have been gilts or bunds or Australia or something. So I think there's a whole list of factors that are explaining this drip higher in bond yields at the long end.
Steve, can I pick out one? And it's supply.
Yeah.
I remember a fantastic paper that you published a number of years ago. You know where I'm going with this. Bonds aren't potatoes.
Yeah.
Can you talk to us about the importance or maybe the insignificance of supply traditionally to DM sovereign debt markets?
The point of the paper was that the supply gets taken down. Bond yields reflect the policy rate and the expected path of that policy rate and where it ends up. So it should be that all available information is factored into the price. Where I think the model has kind of broken down is with these huge shocks like COVID, where we had a big shift in the level of debt, maybe 20-25% level shift, like GFC in 2008. The thing about it is, John, if you look at the 2-year that you were covering just now, the 2-year is totally explained by the policy rate and where it's going to go next. Just in the space of the last 6 months or so, we've had a move from markets looking for 3 rate cuts to as many as 2 rate hikes in a year's time. So that's a net 5 rate hike move, and that explains the entirety, if not more, of the shift in those yields in the 2-year, even out to the 5-year. It's when you get to the 10-year plus that something else is clearly at work, and those yields don't want to go back below 5% at the moment. And I think there is a supply dynamic, but I think it's a bit cheap to say that there's too many bonds around. That's why the yield's going up. I think the explanation is a bit more sophisticated. I think it's related to the performance of stocks, what's happening in Japan. And yes, there is some fiscal risk premium.